One signature, big risk. Business owners often think risk lives inside the business, but a personal guarantee can quietly move that risk onto the owner's personal balance sheet. There is a document a lot of business owners sign that can quietly move their business risk into their personal balance sheet. It usually happens during growth. You're buying equipment, opening a new location, signing a lease, expanding a line of credit, financing an acquisition, and somewhere inside that stack of paperwork, there may be a sentence that says, "You personally guarantee this obligation." That sentence matters because the owner thinks this is a business obligation. But the lender, landlord, or creditor may be saying, not exactly. And that is what I call the personal guarantee trap. Not because personal guarantees are always bad, sometimes they're a part of doing business. The trap is signing them casually, forgetting about them, and never building them into your actual financial plan. The goal is not to never sign risk. The goal is to never sign risk blindly. A personal guarantee is exactly what it sounds like. You are saying, if the business cannot meet this obligation, I may be personally responsible. Now, the exact details depend on the agreement. It could be limited. It may be unlimited. It may burn off after time. It may stay in place until the debt is fully repaid. It may be tied to a lease, a loan, equipment financing, or a credit facility. But here's the point. A personal guarantee can blur the line between business risk and personal risk. And that line is very important because a lot of business owners spend years building legal entities, LLCs, corporations, operating agreements, separate business bank accounts, and then one signature can connect the dots right back to them personally. It's like building a fence around your yard and then leaving a gate wide open with a welcome sign. Again, this does not mean personal guarantees are automatically wrong. That is not the point. The point is, if the risk follows you home, your plan needs to know about it. So why do smart business owners sign personal guarantees without fully planning around them? Because they usually show up at the exact moment the owner is trying to grow. The business is expanding. The opportunity looks good. The numbers seem to work. The bank says it is standard. The landlord says everyone signs it. And the most dangerous phrase in business finance is, it's standard. Because standard does not mean small. Standard does not mean irrelevant. And standard does not mean your spouse knows about it. That last one is really, really important. I've seen business owners who have signed guarantees that affect the family's financial picture, and their spouse has no idea. Not because anyone is being dishonest, but because the owner thinks of it as business paperwork. The family balance sheet thinks otherwise. This is where successful owners get exposed. They are confident, they believe in their business, they believe in their ability to solve problems, and that confidence is part of why they are successful. But confidence is not a risk management strategy. Optimism built the business. Planning protects the owner. The real issue is not just the guarantee itself. The issue is what I call stacked exposure. Here's what I mean. For many business owners, their income comes from the business. Their net worth is tied to the business. Their future retirement plans depends on the business. Their lifestyle depends on the business cash flow. And then on top of all that, they personally guarantee business obligations. So if the business has a bad year, it's not just one thing that gets affected. Income may drop, distributions may slow, business value may fall, credit may tighten, and obligations may remain. That is the part most owners underestimate. Risk does not always hit one line item. Sometimes it hits the whole system. That is why an owner can look very successful, own a profitable business, have strong revenue, and still be financially fragile. The P&L, profit and loss, might look great, but unfortunately, stress does not care about adjusted EBITDA. This is why personal guarantees belong inside the financial plan, not in a forgotten loan file, not in a desk drawer, not in an email from 2019 that nobody wants to open. They need to be visible. Before a business owner signs a personal guarantee or before they renew one, there are a few questions worth asking. Number one, what exactly am I guaranteeing? Is it a loan, a lease, a line of credit, equipment financing, a vendor agreement? Because vague risk is hard to manage. Question number two, is it limited or unlimited? A limited guarantee may cap exposure, an unlimited guarantee may not. Those are very, very different conversations. Question number three, how long does it last? Does it expire? Does it reduce as the loan balance comes down? Can it be released after certain financial conditions are met? Question number four, what triggers the guarantee? Is it only non-payment? Could it be a covenant breach? Could it be a sale? Could it be a default under another agreement? I don't know. Question number five, who else is affected? Is a spouse involved? Are partners involved? Is collateral involved? Are their personal assets pledged? This is where you want attorneys, lenders, and advisors speaking clearly. Question six, how does this fit into my personal balance sheet? This is the financial planning question, because even if the business can support the obligation, can the family absorb the risk if the business cannot? This is where advice-led planning matters, because the answer is not never sign a personal guarantee. That's not realistic. Some businesses need credit, some owners need leases, some growth requires capital. But an advice-led plan should make the risk intentional. That means creating a guarantee inventory. What have you signed? When did you sign it? What is the current balance? What are the release terms? Who is personally exposed? What collateral is involved? If you cannot answer those questions, you do not have a risk strategy. All you got is paperwork. Then the plan should ask, do we have enough liquidity? Do we have enough personal reserves? Is insurance coordinated properly? Is the business too dependent on one person? Are there partners who need buy-sell planning? Are we separating business growth from family security? The business can take risk, but I can tell you the family needs a plan for that risk. That is the difference between being aggressive and being careless. Aggressive can be very, very strategic. Careless is just expensive with better branding. So if you're a business owner and you have signed loans, leases, credit lines, or financing agreements, ask yourself one question. What risk have I personally guaranteed? Because your business may be separate on paper, but that does not always mean your risk is separate in real life. And the sooner you understand that, the better you can manage the business, the family, and the wealth you're working so darn hard to build. If you want more conversations around business owner planning, risks, taxes, investments, and building wealth with intention, subscribe to the channel. That's all I got for today. See ya.